And when you have limited information, you have limited experience, you create this world for yourself that is like, I can't do this because of these reasons, or it doesn't make sense for me because of these reasons. What we're going to talk about today is why you have to do this.
Hey everybody, welcome to another episode of Duel the Day. I'm Nico and Tyler's with me here. He looks like he's doing something.
Hello.
So give us a second. We're going to be talking about investing today. Want to give some high-level overviews of investment strategies, how to perceive investing, different strategies at different ages, just high-level stuff that can help anyone in their money journey or investing journey. And before we get into it, we just need to mention the previous Duel of the Day. If this is the first episode in the series that you're listening to, hit pause and go back to our first episode on money and kind of catch up to where we're at. Every episode is kind of connected and we kind of build off of the previous one. So in the previous episode, the Duel of the Day was figure out where you're spending your money and set up a basic budget. So hopefully all of you have done that. For me, let's actually look real quick. I started doing my budget at the end of 2018, and I've done it every week, month, whatever since then. So hopefully eventually your spreadsheets will look like mine, but yeah, hopefully get that together.
Yeah, and just to butt in on that really fast before we get kicked off here, the doesn't have to be the whole encompassing budget that Nico's got. Like my specific focus was one particular area that was a problem for us,
yes,
spending wise, that I talked about last time, which was our grocery and like warehouse club. So Kroger and Costco is where we spend most of our money for that stuff. And for like the last like 4 months or so, we were like at least $1,000, maybe even 1,200. And sure, yeah, Christmas time was happening, so we're getting extra food and stuff to bring over places. Like, sure, but that was just too much. And so that was like our highest spending category. So I super honed in on that, focused on tracking all of it. I made a spreadsheet. I kept all the receipts, entered in the products just to see if there was any patterns of things that we bought that we didn't use, and just to refine it. And without doing anything different besides being conscious of what we were spending, and by tracking, it wasn't a mindset of like, we're just not going to eat this month because we wanted to, want to reduce our costs, right? We didn't do anything different, but we made a conscious effort to only go once a week. We tried only one Costco trip in the month instead of 2. And we were just under the goal that I set of $800 and ended up spending $784.
That's
so
sweet. Fuck yeah.
Reduced somewhere between $300 and $500 simply by paying attention to it.
Yep.
So that's the power of focusing in, tracking what you're doing. You don't have to be super anal like that, but if you have a big problem area like that, just honing in and putting the magnifying glass on that area, it's going to help. And it might not be that drastic, but at least you'll be able to identify some patterns, right? So sorry, I just wanted to
that. And on last thing I'll say about that's exactly why keeping a budget is great, because it allows you to have a high level focus on everything. And so that you just get a better idea of where your money's going. And that's a great example for projects like that too, because finding out where you can save money off of something like that is big. But let's get into it today with investing. Again, at a high level, I want to talk about the mindset of investing. I know we talked about the mindset of money, but mindset of investing is a little bit different. And we'll put this link in the description. But Tony Robbins has a web page that goes into saving, investing, asset allocation models, and makes it really easy to understand. And I think I'm going to read this to you just because it makes so much sense. So he classifies investments into 3 different buckets. The first is security. The next is risk and growth. And the last one is your dream. Okay. So in your mind, now that you have a budget, now that you understand you're wise about money, all this stuff, let's fill those security and risk growth baskets first. Okay. Obviously, you need the security of your home, you need the security of food, all that stuff. Make sure that bucket's filled. Now, make sure your risk and growth bucket is filled too, with investments that we'll get into today, with different things that can grow your money and things like that. And also set aside, on top of both of those, set aside money for your dream. Okay. That's going to allow you to live comfortably, not have to worry about money as much because your securities are taken care of. You're still saving and pursuing your dreams, following your passions, things like that. And using some of the investment strategies we'll talk about today, you'll be able to grow your money all at the same time. So with that in mind, I think the easiest thing to start off with investment talk is talking about retirement and retirement funds and different things like that. And listen, there is tons of different retirement products, right? Because that's what they are. 401ks, Roth IRAs, different stock investment portfolios, mutual funds, whatever. And all of them have their benefits, pros, and cons. But the most important part is getting started and being consistent with it. Even if it's a low, like you think it's a low amount of money, even if it's $20, if you're consistent with those $20 from the time you're 18 to the time you're 30, you're going to thank yourself, even if it's just $20. And so your everyone's life situation may lead them to a different investment product. But at the end of the day, the most important thing is just getting started and being consistent. So
yeah. I agree. Yeah, the best time to start investing, if you haven't already, is today, right? Yep. I mean, I wanted to go through a couple in a book that I've referenced in a couple other episodes here. I Will Teach You to Be Rich by Ramit Sethi. He has a couple good what he calls our invisible scripts. So basically, limiting beliefs is the same phrase. But about investing, he's got like 7 of them here. I'm just going to pick 2 or 3 of my favorites. There's this one. It's due to my lack of knowledge / experience in it, I don't want to lose my hard-earned money. Okay, not a bad reason, right? Fair. His response is, ironically, every day you don't invest, you actually are losing money due to inflation. You'll never realize this until you're in your 70s, at which point it will be too late. And then in parentheses, he says, I'm fun at parties. Another one, which I think is actually important to understand, because this is a very large misconception, is fees are a big part of it. When you only have a small amount to invest, trading fees can make a big dent in your returns. His response is, it is totally mystifying how people think investing equals trading stocks. Oh, wait, no, it isn't. Every stupid commercial and app pushes this agenda. When you follow my advice, your investment fees are extremely low, which he is exactly right.
Yep.
On that. And then the last one, which is just, I laughed for about 10 minutes, is this person's invisible script is, I ordered a small coffee instead of a large, so I'm saving X dollars a day. Am I adulting? His response is this: you will die alone.
That's great.
But I bring those things up because it's everybody. Listen, I'm a great example of this. I can talk myself into or out of anything. And when you have limited information, you have limited experience, you create this world for yourself that is like I can't do this because of these reasons, or it doesn't make sense for me because of these reasons. What we're going to talk about today is why you have to do this. Like, you are literally going to cripple yourself later on down the road. And even if you're older than we are right now, or if you're younger, amazing that you're listening to this, and hopefully your mind is open, or you're already investing. That would be even better. But the point is to understand, like, this, and some of the stats I'm going to read in a second here were honestly shocking to me, because even though I grew up with very little financial literacy, or people telling me to invest and start early and do all this stuff, I still had a few people that were like, yeah, you just do this, sign the papers, contribute to your company's 401k, put as much in until you max out on the matching. And I've got some stats on that later on. But some of the crazy things here, 3 startling stats about people and their 401ks. So that your 401k, hopefully your company that you work for provides that, and that they also contribute to that. But first one is, only 1/3 of people participate in a 401k.
Wow.
I thought that was super low.
Yeah,
but
that's surprising.
Second one, among people earning under $50,000 a year, 96% fail to contribute the maximum amount to their 401k. So you're losing a lot of long-term investment potential. And then the third, and astonishingly one, is only 1 in 5 contributes enough to get the full company match. The company match is literally free money. So 80% of people are losing thousands of dollars per year. Not to mention how many thousands, potentially tens or hundreds of thousands, that will be over the course of your lifetime. Right. So
that's wild.
It's, like you said, it's super important to get started now if you haven't already, regardless of your age. I mean, we're going to share some stats and tables and pictures of stuff that we'll have links to in the episode details, so you guys can check these out too, because it's a little bit easier to see than listen to to us describe them. But the only other things I wanted to bring up to set the scene here on some of the startling facts. This other table in this book is headed "Older People Regret Not Investing." Shocker, right? So it has this split up as age of employee, median balance in their 401k, and then Ramit's comment, which are all extremely entertaining. So age under 25, median balance of their 401k is $1,300. He says they're too busy watching a cooking show of things they will never cook.
Probably. Yep.
Age 25 to 34, $8,200. These people have just started dabbling and saving money, but still don't see the value in it. 35 to 44, $24,000. These people have realized that perhaps saving money is important. And 45 to 54, only $44,000.
What?
These older folks are wishing they could go back in time and beat themselves for not saving more, like Biff in Back to the Future Part 2.
Oh my God. I was expecting to hear a jump, and that was not a jump.
No, not the jump that you were looking for.
Yeah.
And it just further shows like the mindset around this. And again, like one of the first stats that I read, or in the invisible scripts, it's like all that we see are all of these apps that you can trade and do this and that. Like there's no one really advertising, hey, let's go long term. Let's go index funds. Let's go automation to where that money gets sent to your investment account and then it gets automatically invested for you. Right? It's not, I'm sorry, people. There are some that buy big ticket stocks and it goes crazy and they get a big return on it. That's great. It is not dependable.
No.
And I know it's probably hard to imagine that something super long-term in the stock market is dependable, but over the last assload of years, it has been. So again, long-winded way to say start today if you haven't. Really think about, kind of like we talked in the first episode about your money mindset. Think about those things that are preventing you from investing that first dollar, from maxing out your 401k to where you're taking advantage of all of that employer matching. Right? There's just a lot of little things there. But again, this book's a great resource, much better than we are. But hey, we're doing our job by pointing you towards said resource.
Exactly.
Right? So,
Resources. We're gonna give you more than one.
Exactly. So I just wanted to highlight those things about some mindset pieces there and some stats to hopefully be like, oh shit, that sounds like me. That sounds like how I think about it and how it needs to change.
Dude, those are crazy. And I've definitely looked at a lot of financial stats and things like that before, but like every time that I hear it or I see it, it just blows my mind. Because it's such a simple thing to do, but either people don't know enough about it, they're not comfortable with it, or they just never, in air quotes, get around to it, like whatever the excuse is. But this is a clear way to make enough money to sustain yourself for your entire life. While you're talking about all this stuff, one of the things I think was important to point out is the idea of how much money we need to survive in retirement. Okay. And the example that hit home with me is this one. Okay. I think most of us would agree that $50,000 a year is plenty of money to live off of comfortably. Yes, you might be in a small home or an apartment, but like you're okay. All right. Now, if you had $50,000 for the next 80 years, you'd have $4 million. Now, that's shocking to me because that is a long fucking time. And that is not a lot of money in the grand scheme of things. Because if an 18-year-old invests like $100 a month or whatever in a Roth IRA, by the time they're 60, they're going to have like tens of millions of dollars or some shit. Like those numbers are stupid. So like that 4 million and that $50,000, like it goes to show that it does not take a lot of money to live comfortably, but you have to get started early to get interest to really work in your favor and start to give you that security you're looking for. Because really, if you break down the percentages, if you eventually, let's say you retire with $1 million, right? And it's an 8% return. What does that mean? $80,000 is coming into your account every year. All you had to do was make $1 million. And then what did I just tell you? You can live comfortably off 50 grand. So literally you just have $1 million in the bank, live off interest, take out $50,000 a year, and you're still making money in your account. But all of that didn't happen if you didn't start investing and start early. Now, one of the things that I'd recommend everyone looks out for, and you touched on this a second ago, when getting into investing, is understanding fees. Fees will, and I'm sorry, I'm going to curse, fees will ass fuck you. Fees will totally ruin your investment journey, your investment path. And all it is just understanding the thing you're investing in. As an example, stocks. The reason why there's a lot of fees associated with stocks is not because they are stocks. It's how they are held and how they are traded. If you buy a stock today and then 3 months from now you sell that stock, you have to pay fees on that. You have to pay taxes on that. If you hold that stock for longer than a year, the fees and taxes change on that stock. You're doing the same thing. You're buying stock and selling it, but because you're treating it differently, like a long-term asset, it's classified differently. You don't get as much tax penalty, and you end up making more money off of doing things like that. Also, different companies are going to have different fee structures. So making sure you read the fine print of all of your investment, what did I say earlier, products, the 401k, Roth IRA, whatever it is, as long as you understand the fees associated with that, the fees associated with the company, that's going to help out a lot as well. There are investment companies out there that do not hide the fact that they have extremely high fees, and apparently they still get a lot of business from people that can't read, I guess. Like, I don't know how that works when there's other companies out there that literally try to have low fees to attract clients. So I think that's a super important thing to think about, is fees and taxes, things like that. And when we think about fees and taxes, that also opens up the avenue for some different types of investments. One of those being real estate, because if we think about real estate, you're probably not, unless you're like flipping the house and using it as a product, you're not going to want to sell that in a short turnaround, right? But now if you buy real estate, hold it for a certain period of time, and then sell it at a profit, that's another form of investment. So again, understanding the fees and taxes associated with that. Is it more profitable to buy and sell real estate versus stocks? I have no fucking idea. I'm not an investor, but I would read into it if you wanted to learn more about investing. Those are the types of thoughts. Those are the types of things that I would urge everyone to think about when they're thinking about investing. Because it is a, how would I describe it? It is an extremely detailed and almost overwhelming world. A lot of different products, a lot of stuff going on. But once you understand the fundamentals and how these things work, it's pretty easy to understand what's happening and what you need to do with your money. So
yeah,
just wanted to point that out, or those things out, because I kind of rambled there for a second.
No, you're good. No, that's super important. I got actually some good numbers here to support what you're saying, but before I get into those, like that's, and I think, I don't know if it was the last episode or the first one we did in this series when we were talking about if a financial planner is worth it or something, right?
Yeah.
Because they're going to charge you those fees, or their expense ratios, or if your things that you're investing in are actively managed mutual funds. All that means is somebody that thinks that they know something about the stock market is moving your shit around for you and charging you for it.
Yep.
Nobody knows anything.
Yeah.
Really. I mean, sure, some people have really good track records, but it's because of how their investments are structured. Are structured, right? It's not nobody knows if said new stock is going to be, the next Amazon, and it's like, okay, we're just going to buy into that anyways. So that's why when you're just starting out and you're looking at things for retirement. Now, if you have extra money after you've already put stuff into your retirement and those boxes are checked, like we talked about in the last episode, where, you've got your money going towards your savings account, you got your money going to your investment accounts, all those things are taken care of, and you've got your guilt-free spending account, all that good stuff. If you want to go crazy and invest in whatever the hell you want, go ahead. See if you make a couple bucks. That's great. That's what you want. But you want to have that security long term, and index funds are the best way to do that.
Yep.
If you don't know, index fund, just think of it basically like mirroring an area of the stock market. And
so like tech, commodities, whatever. Yeah.
Exactly. So basically, as like the whole general sector or area of your index fund goes up or goes down, your index fund mirrors that. So you're not just investing in 1, 2, or 3 different companies and you kind of live and die by their balance sheets. It's the whole broad spectrum.
Yeah.
Which is why long term that's great. But the other thing, and to tie into what you were talking about with fees, they are the lowest cost expense ratio fees out there. So in this table I'm looking at, index funds on average might be 0.14% of an annual expense ratio. The ones that I have are actually 0.08 or 0.06. So even less or half of that. Now your average annual expense of an actively managed mutual fund is 1%. 1% doesn't seem like a lot.
But it's 10 times more than what you just talked about.
Right. And when we throw some dollar amounts in here, like I'm about to do, it gets a little bit more extravagant. If you have $5,000 in your portfolio, your annual expense of your index fund will be $7. If you have an actively managed mutual fund, it's $50. Not so crazy. I'm going to skip all the middle ones. Let's go down to when you're at 500,000 in your portfolio. So you've been actively investing for a while. Things are going good. You're consistent. That index fund that you have, or those index funds, that's going to cost you about $700 for the year. Okay. That's just kind of the cost of investing, right? There's a price to it.
Yep.
Your 1% fee that you thought was so little just cost you $5,000 that year. Okay. And if you make the jump to $1 million, obviously you double that, $10,000. And that's just for one fund.
And basically, so everyone understands how stupid this is, that's basically getting some random kid out of college to just like check off some boxes and click some buttons on a computer that moves your money around. That's what that money is going for. That it is not some like smart person in this back room that's making money moves for you. It's literally this random person.
Right. Because what if they make the wrong moves too? Now they still made the same amount from you, maybe a little less, but you lost way more, right?
Big time.
And the other thing with fees that I did actually look up, because we had talked about it last time, was like if a financial planner like charges you like a 1% or something over your entire portfolio or for whatever they're doing for their services, and they're not like a fee only financial planning, it's based off of the amount in your portfolio. That 1% is done quarterly.
Ooh.
And so just think of over the course of your money, maybe gaining. So, geez. All right. So if we look at it,
use like 8%.
If you use an average 8%, and obviously you're continually contributing to this account, so there's more money being invested and moved around, right? That 1% is going to almost cost you, I'm pretty sure the figure that I saw was almost in the 60% of your realized gains over the course that you were investing with that planner, because it compounds quarterly, and 1% here and then another 1% over the course of 40 years, 30, 25, 30, however long.
Yeah.
It is
insane.
Astronomically more than you think it is. And so when you go the index fund route, setting up through websites like Vanguard or Schwab or whatever, it's so easy. It's really easy to do.
Yeah, and it takes that like worry or concern or like wonder, like you're always wondering, is my money doing okay? Like what's going on? Am I going to hear from this guy? Doing something like an index fund takes all of those thoughts out of the equation. You're not going to have those worries when your money is in something like that type of vehicle.
Yeah, exactly. And it's not like it's one of those things that it's like the crock pot. You set it and you forget it. You keep contributing money to it. It makes it doesn't help you at all to be checking how much it's gained daily and all that stuff. It is just think of it as a very high yielding savings account, because the way that they're set up, and if you are making sure that your asset allocation is correct, which we'll get into here, it's going to give you that growth potential early on, but also the security later on when you're coming closer to that retirement age.
Yep. And that's actually a good segue into talking about age and how investment should probably change a little bit based on what age you're at. Because that is a thing. Like, obviously, if you're listening to this and you're 20 years old, you're probably going to have a totally different investment strategy than someone who's 40 or 50, right?
Mm-hmm.
So in Tony Robbins' book, Money Master the Game, this is a general percentage layout for where people should put money. Like if he was going to send out, I think he asked Ray Dalio something along the lines of, if you had one investment strategy or one investment layout to give everybody, what would it be? And this is what they came up with. So 7.5% in gold and commodities, 15% in U.S. intermediate bonds, 30% in stocks, and 40% in long-term bonds. Now, what I want everyone to take away from that is not the names that I used, it's the percentages, and you could flip around the names for something similar that has a similar level of risk, right? So the stocks, for example, is at 30%. Well, that's just a slightly riskier asset or riskier vehicle. So instead of stocks, maybe you're investing in crypto, maybe you're investing in emerging markets, maybe you're investing in whatever. That's that level of risk. Okay, you probably want to put around 30% of your overall investment money into that. 40% in this graphic was long-term bonds, but that's more like a savings account type thing, right? Or a retirement account. So put 40% into that. That's the type of mindset that I think people should have. And what this does is it mitigates risk without totally reducing your exposure. Because in the money world of investing, people have to accept some level of risk. Like you're not going to, you might as well just keep cash in pillowcases underneath your mattress or some shit, because like there is going to be a level of risk with investing, but that's where people make money. And so if you put your money in areas that have high levels of risk and low levels of risk, okay, well, you're mitigating any bad stuff that could happen. So I think that's an, again, important like idea to have when it comes to investing, is making sure that it's spread out in a way to mitigate any risk, because just like markets usually, like they've been going up for a while in the US, they go down too, right? We're in that down part right now. And so if you have a good asset allocation, yes, your portfolio is going to go down, but it's not going to get cut in half because you were all in on crypto or all in on emerging markets or whatever the high risk asset is. So whenever you do invest, make sure you spread it out, because last thing you want is to, I'm going to go all in on Enron. It's a great company I've heard of.
Yeah. Right. Yeah, I hear that. And you made me think of, I don't have it pulled up here, but I saw it earlier today, was, a little small graph on, they had three graphs of somebody over the course of their, 65-year career until they were 65, starting at age 25 or something, invested at all of the perfect times, like all of the highs, or sorry, not the highs, like the perfect time to invest. So lower to maximize the returns. Then the person that invested at all of the worst times over the same 40-year period. And then somebody that just saved money. And it was like the person that saved money over those 40 years had like $35,000. The person that had invested, and it was a very small amount too, so the numbers are small, but the person that had invested at all the perfect times had like $97,000, and the person that invested at all of the worst times had like $88,000. So when you think about like another invisible script, right? Like, I don't know the highs and lows. I don't know when to go. I don't know if now's the right time or if I should wait. It doesn't matter.
Yep.
Like it does not matter. But the other thing that I wanted to mention too on the asset allocation that you were describing is kind of what different funds have to offer and how that they're managed. So looking at sort of a basic pyramid of investing options, at the bottom of the pyramid, things that you have high control over, but you have a high time requirement, are basically your bigger individual stocks. If you're going to if you're going to trade all of this, which I don't recommend doing for retirement purposes, like we're talking index fund going long term, but you have stocks at the bottom. Then the middle chunk, you have your index funds or your mutual funds because they're convenient. The index funds have low fees or the high fees of mutual funds. You do have a little bit more, you have a little less control, than the stocks area because those funds are separated and kind of managed, but it's not a bad thing. But when you're looking for ease and convenience, are the target date funds. So when you're starting up your 401k or you're moving on from that to set up a Roth IRA plan for yourself outside of what you're doing through your company, which is another great idea. Doing a target date fund can be very simple because those specific asset allocations are set up based on the year that you're going to retire, and they automatically reorganize themselves throughout the life of that fund. So to give you an example, if you bought a bunch of your own index funds, so let's say you had some large growth stocks, small growth stocks, some real estate areas, and then you had bonds, a couple different types of bonds, and then you might have had some international stocks as well. It's kind of a similar basic kind of outline for that. If you have those and you bought those funds yourself individually, let's say your small growth stock goes up 30% this year. Let's say your real estate stock goes up 15%. Let's say your large cap that you have the most percentage in goes down 5%. At the end of the year, you're going to have to go back and allocate that money, those gains from those other stocks, to make sure that those percentages are still in line with where you are in the terms of your age and your career. Because otherwise they're going to get out of balance. Now a target date fund does that for you. So super convenient, very easy. Like if you're like me and just want to I'm going to send money to something and it's just going to do what it does. That's what you want. If you want some higher control, you can buy your own individual stuff and you can tinker with it and manage it around. It gets messy. Just from what I've read and how the process actually goes out, it's pretty intricate. It's not as simple as saying, hey, I'm going to move, $100 here over to this.
There's a lot of requirements. Yeah.
There's a lot of things like you're going to have to pause your automatic withdrawal that's going there to certain areas of those funds until they balance themselves out. So basically you would stop putting money into that real estate index fund that went skyrocket last year until the other ones even themselves out. And it's very, it sounds like no fun to me.
Yeah. No.
So the target date funds are just a simple, just great way just to have access to all of those great options at the scale of the index fund. It doesn't cost anything extra as far as an expense ratio as what buying those funds individually would be. So it's great. You just have less control. So it's the only caveat, but for me, that's the biggest plus side.
Yeah. No, and that that whole set it and forget it thing is super important when it comes to all of this stuff, because you don't want to have to be thinking about how the market's doing and how your retirement funds are doing and stuff. You don't have to think about that every 2 weeks or every month when you're doing budgeting stuff. Like that's annoying. So yeah, setting up something that grows without you having to think about it, and you can do automatic payments and shit, that is the way to go. And I wanted to mention something before we talk about like asset allocation any further. Every single person is going to have a different asset allocation that works best for them. So their age is important. How much money they're dealing with is important. Their goals are important. And so there's no one way to do all of this. That's why we're talking about a lot of different options. It's why there are so many options. There's more than one way to skin this financial cat. So
Yep.
Just because we're talking about a few specific products or investment vehicles, these aren't the only ones. Like read these books that we've read, go out and listen to investment seminars or pull up YouTube videos or whatever. There is an endless amount of information on how to allocate assets and how to invest. But hopefully we're showing you that there are certain investment vehicles that take the thinking out of investing and make things a lot easier to manage long term.
Yeah, definitely. And because I failed to mention it back when we were talking about making sure you take advantage of your employer matching, I have the table in front of me now.
Nice.
And
Oh my God, it's gonna be
basically,
good.
yeah, I mean, this is pretty fucking crazy. So
Yeah.
if you do not contribute enough money to your 401k to take full advantage of your company's matching, please listen to what I'm about to tell you. Basically, if you start at age 35, so older than when you should start. However, like I said, the best day to start is today if you haven't. If you start age 35 and you earn roughly 8% on your money, and you are contributing contributing $3,000 a year. Contribute $3,000 per year. You make 60 grand per year. So that's 5% of your salary. Your employer matches up to 5%. So if you're contributing that full $3,000, your employer is contributing $3,000. So at age 35, you're going to have $3,240 at the end of that year based on 8%. You contributed 3,000, you gained 240. Obviously, math's pretty simple there. With the employer match, you'd have $6,480. Pretty easy. I'm going to jump to age 50. Skip a couple lines here for the sake of time. Without employer match, you'd have $87,972.85.
And so the person's been working there for 20 years.
So that's been 15 years, okay. Age 35 to 50.
Still a long ass time. And that's not 15 years.
Okay. Right. But that's maxing taking advantage of, not taking advantage of employer matching, but also that's no other investments outside of that. It's no Roth IRA. It's no anything else. If you were taking advantage of your employer matching, you'd have $176,000. So more than double, right? At age 65, so retirement age, balance without employer match. So you've been there for 30 years, not taking advantage of your employer matching. You'd have $300,000. Wow. $367,000 and 37 cents. With employer matching, you'd have $734,000.
Wow.
And 75 cents.
That's crazy.
So simply by utilizing your employer matching, you're going to make way more
in the long run. And that's the key, man. Play the long game when it comes to investing. I think the only thing I will say when it comes to investing, and this really only applies to the last like decade, is crypto and how specifically Bitcoin, how that plays into the whole investment landscape and how to utilize that, things like that. That's probably the only air quotes investment tool that's different than stuff like a Roth IRA or your 401k or stuff like that. But all of those long-term options, like that's how you have to play it.
No, you're right. And so to give a couple easy hopefully just 3-step action ladder, I guess, if you do not utilize your company's 401k, take advantage of the matching, max that out. Okay. If that means that you have to save a little bit more and you have to be a little more conscious with your spending, do it. Okay. Sorry, it's just the truth.
Yep.
After you are doing that, the next step, if you have money investing over, remember from the last episode, we talked about 10% of your take home pay go towards investing. Now it can be more if you want, but 10 is a great starting number if you can. So if you have more left over after fully maxing out the matching portion of your company's 401k, then move into a Roth IRA. The best part about the Roth IRA is, unlike the 401k, you pay tax now instead of pay tax later. And the question I always ask when people say, oh, why'd you do that? Why'd you get that? Why do you want to pay the tax now and not later? It's like, well, hopefully when I'm a lot older, I'm going to be in a higher tax bracket. Hopefully my income will be much higher than it is now. So not only am I saving money on that, do you think taxes are going to go up now in the next 30 years, between now and 30 years from now? Maybe. I don't know. Probably. Who knows? So being able to have that other side of the coin from a tax perspective is great. And then third is kind of what I had said earlier. If you have more money that you're trying to invest with, that you want to take advantage and get into the finer market details that I don't know shit about, go right ahead, get into trading individual stocks, go into options, whatever floats your boat, go ahead. But those first two things are where that 10% or more of that take home pay needs to go to really help yourself out in the long run. I mean, the stats that I read at the top of the episode are surprising, and hopefully you all listening found them very surprising. And it shouldn't be a surprise that most older folks regret that they didn't start investing earlier.
Yep.
And when you hear that the average retirement account balance between people age 45 to 55 is less than $50,000, listen, that is not going to get it done.
No,
that is absolutely not going to get it done. And it might be hard to think that long term, but there is so much peace of mind knowing that you are setting those things up automatically, just like we talked about with the savings account and all that other stuff. You can, when you set up these accounts, first of all, the 401k comes out of your paycheck. You don't even have to do that. They do it for you. So There you go. And when you do utilize a Roth IRA or another form of retirement investing, there's an easy option with you link the bank account and you can set up an automatic withdrawal from your bank account on a monthly basis or whatever to then go ahead. Now, the one huge star, and this is the last thing I'll say, because this is apparently a very real thing, to give Vanguard, for example, a great site where you can buy index funds or target date funds at good expense ratios. The biggest thing that you have to remember to do is if you send money to your brokerage account, you then have to invest it. And I know that sounds really stupid,
Yeah.
but there was actually an anecdote in the book, I Will Teach You to Be Rich, about somebody that had contributed to their brokerage account.
Oh my God, no.
For 10 years.
Oh my God, no.
And then got into it and was like, what's going on with this? She never invested it. So you have to, you only have to do it once, is to set up the fund you're actually going to buy. And then once you set up that automatic withdrawal and automatic investment, it takes care of itself after that. But you have to make that first step.
That's wild.
Because I think, and it's somewhere in this book, the actual dollar amount that she lost because of that, and realized, and it was somewhere of like $70,000 in potential gains that were never realized.
That
and
hurts.
Like that, I felt pain reading that.
And
that's the steps.
Yeah, and that's why I was calling all of these different things Roth IRA, 401k. I'm calling them products because of that. So that all of these companies, investment companies like Vanguard, they're going to take your money, but then they have to they have to put it in a product. They have to put it in somewhere. And so that, to your point, like that's why it's a two-step process. It's not like, I'm going to just send my money to Vanguard. No, it's
more a glorified savings account at that point.
Yeah, not even. Doesn't give you interest. Fuck. Yeah. Well, I think that's a great high-level summary of investing. A lot of good data, a lot of good perspectives. Was there anything else that you wanted to touch on?
I don't think so, man. I mean, there's now that we've been talking about it for a little bit, I mean, there's so many things that we could talk about, but like at the point of just there'd be no return at that point, right? You got to draw the line somewhere. And I think it's the basics of investing for your future. It's not to invest to make $100 tomorrow when the market opens.
Yep.
Those are great ways to learn about and to figure out on your own about investing. But what we really wanted to highlight is how you can set yourself up for the long term, make it easy on yourself, make it convenient, make it automatic, and you are going to thank yourself, your family will thank you, all of that.
Big time.
So that's what I would end with there.
Well, with our episode on investing here, I think the duel of the day should kind of go in line with investing. And since I definitely don't want to tell people to go out and just throw money into something random, I think that I like the duel of the day to be to either start reading an investment book. So like Money Master the Game or Principles by Ray Dalio, or I Will Teach You to Be Rich by Ramit Sethi. Anything like that. Heck, go to the Tony Robbins article in the description and read that, and then go to 5 more links about investing. But the duel of the day is to just learn more about the investment landscape, and hopefully you'll start to take the first steps to making investment choices for you. So with that, thanks for tuning in to this episode of Duel of the Day. And stay tuned for our next episode, where we'll be giving some specific examples and talking about big events and big purchases, weddings, cars, houses, engagement rings, just big life stuff that comes at you. Knowing how to deal with that is kind of important. So we're going to talk about that, and we'll give you guys another duel of the day to empower your own lives. Be sure to subscribe at our website at dueloftheday.com and to our podcast channel on all major streaming platforms so you don't miss a thing. We'll see you guys again next time on Duel of the Day. And as always, begin the duel, win the day.
Peace.